Amid first quarter recession chatter, the S&P companies have given investors a tailwind by surpassing, admittedly modestly, the expectations. This time around, the bar seems to be higher, but as talk of an earnings recession continues, will history repeat itself? And is simply beating the street not enough this time? With more on what to expect, let's bring in back Victoria Fernandez, Crossmark Global Investments Chief Market Strategist. Victoria, so we've been having this sort of high bar, low bar conversation going into earnings season here. What do you think here? Are our expectations running too hot or too cool going into the numbers?
Well, look, no one wants to overpromise and underdeliver, right? We always see companies do the opposite. So expectations down around 7% for this quarter. I think companies have set themselves up in a position where they can at least hit expectations, if not beat expectations. You had a lot of concern just 6 weeks ago that the banks were going to have a horrible quarter, and people were very concerned. We saw banks take a big hit after March when all the stuff was going on with the regional banks. We actually at Crossmark stepped in and started buying some of these banks because we knew that their balance sheets were strong, and I think that's the key component. When we look at earnings this quarter, let's look at the quality of earnings. Don't just look and see did they beat expectations, but what is the quality of their earnings? What do their cash ratios look like? What is management doing in this volatile environment? You're going to have to piece through it a little bit, I think, to see which companies can really do well in the second half of the year, as we think there's going to be continued volatility going on. But for right now, beating expectations seems to be okay, as all of these stocks that have reported so far have been up, and the big names today are even bringing up the regional banks with them in the pre-market.
Yeah, Delta CEO Ed Bastian told us that this would be a choppy earnings period, and really laying out some of the bifurcation between some of these services versus goods producing companies that are going to be reporting here. As you think about where that bifurcation may be taking place from your perspective, what most notably would you be watching for?
Yeah, when you look at goods versus services, right, we saw the disinflation come in the goods first, and we expected that as supply chains got better. And we're continuing to see that supply chain improvement, which means we should continue to see disinflation in the goods services. The question I think comes in, and we touched on it just a little bit earlier, is the pricing power of some of these companies. Does that start to erode as we go into this new kind of environment in the second half of this year? And if it does, what does that mean for margins for these companies? I think it's a very key ingredient that could really kind of separate companies from each other, even within the same sector. What do those margins look like? How are they controlling the cost? We talked about cost at banks, but you think of cost across the board and how so many CEOs are focused on really reducing those costs that they have. So margins, I think, is going to be something we really want to watch. Services continue to do well. We saw core service spending or core service inflation continue to go a little bit higher in the CPI report. They say airline prices are down 20% year over year. I haven't seen that, but it must be out there somewhere. But maybe we'll start to see it a little bit more in services. It's just not quite there yet.
So on balance, are you bullish or bearish, Victoria?
Yeah, it's hard to tell sometimes. I even question myself, but we're typically more bearish than I think the average money manager is out there, or the average investor, because there's so many factors out there, Julie, that are saying, wait a minute, we're waving a red flag here. We've talked about the inverted yield curve with the banks. Look at M2 money growth. Leading economic indicators down. I say it all the time. I sound like a broken record. 14 months in a row. We've never had that without going into a recession. So you have to sit back and go, then why aren't we there? Why haven't we gone into a recession? And are we being stubborn in that outlook that we think we will see a large pullback or a mild recession, however you want to categorize it, in the second half of this year or towards the end of this year? And I think it comes back to the consumer is spending more than they ever have. And it also comes back to the fiscal stimulus that we've seen from the government. You've got infrastructure bills coming into play. So we have manufacturing PMIs down. They've been in contraction territory for multiple months, but we have factories being built at the fastest pace we've seen in a few years. So there's these contradictory things going on that tells us it's going to be choppy, but we're still leaning right now towards having again, however you want to categorize it, a mild recession, larger pullback in the fourth quarter of this year, but we are giving credence to the fact that perhaps we pull it out and get a soft landing.
And so, even within that environment, so many companies have continued to say, all right, macroeconomic backdrop, just so challenging to really give proper guidance or go without perhaps sandbagging the guidance that we are giving. So are we looking at a continued period of time where companies are just going to continue to either kind of lower or level set their earnings and then just continue to beat on lower expectations?
I think that's probably going to be their goal, at least for the next couple quarters. They probably want to get to a situation where the Federal Reserve gives a pretty clear outline of where they're going to stop raising rates. When they're done, they want to get a clearer picture probably of what other central banks are doing, the ECB and the Bank of England, when they're going to be done. Then at that point, I think companies are more willing to take a little more adamant stance, be a little bit more risk on. But it's tough to do that when you don't know for sure exactly what the central banks are going to do and what that inflation looks like. Yeah, we had a great CPI number, but let's see that trend go a little bit closer down to the target rate of 2%. We still have quite a ways to go before we get there. So I think companies will be cautious. I think investors should be cautious, Brad. I mean, we're a little more bullish than the average person, but yet we still want to be in the market. We're just trying to choose where we're in the market a little bit more carefully based on that outlook. So I think companies can maybe take that same cautious optimism when they're doing their business.